Okay, so this is exercise M2-10. That's on page 75 in your textbook. So 2-10 says for each of the transactions in 2-9, just above it, including the sample, write the journal entry using the format shown in this chapter. Now I'm not going to use that format specifically, but it's basically the same, and we'll see why in just a minute. So I'm going to use this analysis template that I've also posted on Blackboard. That just helps us kind of think through the financial statement effects of the journal entries we're going to book. So we'll start with the first one. We'll just make sure we mark that letter A here. That's the sample from 2-9. And it says borrowed $3,940 from a local bank on a note due in 6 months. Okay, so when we borrowed $3,940 from a local bank, they presumably gave us cash or a check in that amount. So we're receiving cash here in the amount of $3,940. Now I'm going to fill in these columns and explain each one as I go here. So account class just means the account classification. What type of account is it? And we'll abbreviate these. Cash is an asset, so we'll just mark that with an A. We'll mark an increase or decrease in this column. So again, here we're receiving cash, so I'll just mark that a plus. And cash is increased by a debit, so I'll mark a debit there. Now what else happened here? Well, I borrowed $3,940 that I've received in cash here on the first line. So now I owe $3,940 to the bank. So we'll indicate the notes payable account. That's our formal bank loan. That's a liability account. That's also increasing in this case. Okay? And the way we can think of that is before this transaction, I owed the bank nothing. Right? Now I owe them $3,940. So my liability to them has increased. Liabilities are increased by a credit, and we have the same $3,940. Now if we think about our income statement accounts that I've just highlighted, there's no effect here from this transaction. I've only affected an asset account, cash, and a liability account, notes payable. So just for my own sake, I'm going to say over here on this line, assets have increased, so have liabilities. Stockholders' equity's done nothing, and therefore my balance sheet is still in balance, right? Assets equal liabilities plus stockholders' equity. So this left side has increased by $39.40. This right side has also increased by $39.40. Okay. Again, there's nothing formal about these columns here. We're just using them for our own purposes to kind of keep track of what's happening. Now, SCF means statement of cash flows. And since this transaction involved cash, we would see its effect on the statement of cash flows. Remember, anything involving debt, financing of the operations, we consider a financing activity. In this case, we've received cash, so I'm going to indicate a plus for a cash inflow. And that's it for the first one. Now it's important to note at this point that really I'll highlight here the only parts that you would kind of formally see on a journal entry in a general journal. Usually we'd have just the account names with our debits listed first, our credits indented afterward. We would probably have a date and then the dollar amount. So let's try the second one here, letter B. It says received $4,630 cash from investors and issued stock to them. So again, we know we have received cash. As we mentioned a moment ago in letter A, that's an asset account. It's increasing here, so we would debit it for the amount of $46.30. Now what are we crediting? Well, we've issued new stock to investors in exchange for this cash. So we're going to call that capital stock. Sometimes we'll see that as contributed capital. Either one's fine as long as we are sure we understand what that means. Capital stock or contributed capital is a stockholder's equity account. Again, that's increased here, but equity accounts are increased with credits. Again, no effect on my income statement accounts. I've only affected an asset and an equity account, so nothing happens on the income statement. On the balance sheet, my assets have increased, as has my stockholders' equity. So I'm still in balance, right? Left side increases, right side increases by the same amount. And here again, from a statement of cash flows perspective, any issuing of new stock is a financing activity as well. If we take a look at letter C, it says we purchased $1,000 in equipment, paying $200 cash, and promising the rest on a note due in 1 year. So based on that description, we know we have 3 accounts to worry about. And we can break this up into pieces if we find it helpful. So for instance, the first part of that statement said purchased $1,000 in equipment. Stop there for a moment. We know no matter what happens after that comma, I need to increase my equipment account by $1,000. Okay, purchased $1,000 in equipment, boom, equipment increases by $1,000. Now, equipment is something we own, and it's going to provide some future economic benefit to us, so it is also an asset account. Again, we've increased it, and asset accounts increase with debits. So I'm debiting equipment for $1,000. Now it says I paid $200 cash, so I can again stop there after those 3 words. I know that I've decreased my cash account by $200 for that payment, that down payment. It also says I promised the rest on a note due in 1 year. So notes payable, I owe the remaining amount. Notes payable, we said, was a liability. We're increasing what we owe, so we're increasing our liability account with a credit for the remaining $800. Still nothing happening on the income statement here. My assets have increased by $1,000 and decreased by $200. So in total and on net basis, they've increased, as has my liability total. From a statement of cash flows perspective, I do have $200 in cash going out. In the purchase of fixed assets, we consider an investing activity. So I'll mark that as an investing outflow. A couple things we always want to keep in mind for our journal entries. For any particular transaction, we want to make sure that total debits equal total credits. We also want to make sure that any effect we have on asset accounts is equal to the same effect we have on liabilities plus stockholders' equity accounts. Those are always a couple things we want to check. So let's run through those for this. So we had $1,000 in debits and $1,000 in credits. So we're okay there for that first check. We've increased our assets by a net amount of $800 here. We've increased our liabilities and equity by a total of $800 here. So our balance sheet's still in balance. So we're okay there. It doesn't guarantee we've booked everything correctly. If we have the wrong accounts, we may still be incorrect. But at the very least, we know we're hopefully on the right track. We know that our debits equal our credits and that our balance sheet's still in balance. Letter D says we paid $300 cash for supplies. So we have purchased supplies. So I want to increase my supplies account by $300. Supplies, of course, is an asset as well. It's something we own, something we're going to use going forward. I did pay cash, so I want to decrease my cash account by the same $300. Now, I still haven't touched any income statement accounts. My assets have increased by $300 and decreased by $300. So that's a net effect of absolutely nothing, right? So I don't need any change in liabilities and stockholders' equity. My balance sheet is still in balance. Assets have gone up and they've gone down by the same amount. Of course, my total debits equal my total credits here because I only have 2 accounts I need to worry about. And from a statement of cash flows perspective, supplies and things of that nature, we generally just consider operating activities. Okay, it's really only the fixed assets that we consider investing activities. So we had just one more transaction here, letter E. which says bought and received $700 of supplies on account this time. Well, we know we still got supplies. We agreed supplies was an asset account, so we're going to increase that with a debit in the amount of $700. This time, though, we didn't pay any cash, so we owe our supplier $700 at a later time. So we'll just go ahead and call that accounts payable. Accounts payable, again, something we owe, so that's a liability account. We increase liability accounts with credits, and we're done with our journal entry part of that transaction. So again, for our own sake, we'll do our checks here. $700 in total debits, $700 in total credits, so we're okay from that standpoint. Now if we check our balance sheet, our assets have increased by $700, our liabilities have increased by $700, and we're all set. We're still in balance. Now be careful on this one. From a statement of cash flows perspective, we actually don't have any activity. Okay, we did purchase supplies, but no cash has changed hands. Only if I see cash as one of my accounts in my journal entry do I worry about a statement of cash flow effect. Okay, now we're looking at M2-13. That's on page 76 in your textbook. So 213 says JK Builders was incorporated on July 1st, 2013. Prepared journal entries for the following events from the first month of business. If the event's not a transaction, write no transaction. And M2-14 right below that wants us to analyze the accounting equation effects of those transactions. So we're going to kind of do both at the same time here in our analysis template. So letter A in 213 says receive $70,000 cash invested by owners and issued stock. Again, I encourage you, especially as you're getting more familiar with booking journal entries, to try to break any transaction up into a few different parts. So this one, for example, the first three words are received $70,000 cash. If I stop there, I already know one of the accounts I need to affect here. That account is, of course, cash, which we have agreed in the past was an asset. I'm increasing it with a debit in the amount of $70,000. Okay, well, why did we receive $70,000 cash? Well, this was money invested by owners, and in exchange for that money, we've issued new capital stock. So I know that the other account I need, the only other account, is capital stock or contributed capital. That's an equity account. Again, we're increasing it because we've issued new stock. Equity accounts are increased by credits. That's the same $70,000. Now, no income statement accounts have been affected by this transaction, but we have affected some balance sheet accounts. So assets have increased by $70,000. That's the cash. And our equity accounts have increased by $70,000. That was the capital stock. So we're still in balance, right? Our asset increase on the left side of that equation is equal to the liability plus stockholders' equity increase on the right side. From a statement of cash flow perspective, any transaction involving our own capital stock, whether that's issuing new stock, paying dividends on that stock, always a financing activity. And in this case, we're saying that's a financing inflow because we've received cash in exchange for stock. As with all of our journal entries, we want to make sure that our total debits equal our total credits as well. In this case, it's very quick to see because we only have two accounts. One was a debit, the other was a credit. So we're okay there. If we move on to letter B, that says we bought an unused field from a local farmer by paying $60,000 cash. As a construction site for smaller projects, it's estimated to be worth $65,000 to JK Builders. Well, let's figure out the accounts first, and then we'll talk about an amount. So we're buying an unused field. We'll just call that land. Land is something, in this case, we certainly own. We're going to use it for some future economic benefit. So it is an asset account. We're buying new land, at least new to us, so we're increasing that account. Assets are increased by debits. We are paying cash. Cash is also an asset. It's decreasing here, and we decrease assets with a credit. Now it says we paid $60,000 in cash, but it's worth about $65,000 as a construction site. Invoking our cost principle, which if that doesn't ring any bells, revisit that from chapter 1. We typically record the acquisition of assets at historical cost, what we paid for them. So we want to book $60,000 here. In essence, we don't care right now that it's potentially worth $65,000. Nothing's happened to any income statement accounts. From a balance sheet perspective, the only side we're concerned with is the left side here, assets. That's increased and decreased by the same amount, so we're still in balance. Purchase of fixed assets is considered an investing activity on our statement of cash flows. In this case, cash is going out our door, so that's an outflow. Okay, letter C here says a lumber supplier delivered lumber supplies to JK Builders for future use. The lumber supplies would have normally sold for $10,000, but the supplier gave JK Builders a 10% discount. JK Builders has not yet received a bill from the supplier. So that last part actually doesn't matter. It doesn't matter that we haven't gotten billed yet. We did receive delivery of our goods, so we can go ahead and consider that a transaction right now. We've received supplies. Supplies are owned by us, so it's an asset account, increasing that with a debit. Now again, it doesn't matter that they are worth $10,000. We purchased them for 10% less than that, or $9,000. So that's what we're going to record for our supplies here. Now we haven't given them any cash yet, because we in fact haven't even received a bill, but we do owe them for those supplies. So we need to book an increase to accounts payable to reflect that. Okay, we owe our supplier an additional $9,000 here that we didn't owe them before this event happened. So that's increased our liability to them. Nothing's happened on the income statement. Here on the balance sheet, our assets have increased by $9,000, as have our liabilities. So we're still in balance. No cash has changed hands, so I don't have any statement of cash flow effects to worry about. Letter D says we borrowed $25,000 from the bank with a plan to use the funds to build a small workshop in August. The loan must be repaid in 2 years. So we'll focus on the critical components of this description here. Borrowed $25,000. Stop right there. I know no matter what happens, where I got that from, what I'm going to use it for, I've increased my cash or cash equivalents by $25,000. So go ahead and increase your cash account and then worry about the rest of it. So where did we get that $25,000? Well, it's from the bank. We obviously need to repay that, or they expect us to repay it anyway. So we'll go ahead and increase our liability to the bank in the form of a notes payable. Again, we credit liabilities to increase them, and that's $25,000. So here on our balance sheet, our assets have increased by 25, liabilities have increased by 25, so we're still in balance. On our statement of cash flows, we consider these type of activities, borrowing from the bank, paying them back at some point. These are all financing activities. In this case, it's a financing inflow because we've received cash. If we were to repay this loan, that'd be a financing outflow. Letter E says one of the owners sold $10,000 worth of his stock to another shareholder for $11,000. Now go with your instinct on this one. One of the owners selling his stock to someone completely unrelated to the company has no bearing on the company's financial transactions. Okay, that's no transaction for the company. We need to invoke our separate entity assumption. That is, the only transactions we're booking in the company's records are those transactions that are part of the company's economic activities, not necessarily the owners. We don't really care what's happening in that regard. So no transaction for letter E. Okay, this is question number 21 on your Chapter 2 Connect homework. And 21 reads, a company issues $20 million in new stock. It later uses the cash received to pay off promissory notes. How many different accounts and which account names are affected by these two transactions? Now they do give us the hint that those are two separate transactions, but we need to definitely get into the habit of making those two separate transactions regardless, okay? So let's deal with the first one. A company issues $20 million in new stock, and that's in exchange for cash. So we know that we've received cash. Cash is an asset. We've increased it. So assets are increased with debits, and that's $20 million. So I'm just going to abbreviate 20M here. Now that was in exchange for capital stock or contributed capital. Contributed capital is a stockholder's equity account. We're issuing new stock, so that's an increase to that account. Equity accounts are increased with credits, and we've got the same 20 million. Over here on our balance sheet, we know that assets would increase by 20 million. Stockholders' equity would increase by 20 million. So we're still in balance. On our statement of cash flows, we consider these type of activities financing activities. It also said we later used that cash to pay off promissory notes. So now we're reducing our liability to whomever we owed this money to, right? Promissory notes, just a loan agreement basically. So we'll go ahead and call that notes payable. It says we're paying off $20 million in promissory notes. So notes payable is liability, right? It's an amount we owe to someone else. We're decreasing that account with a debit because we're paying it off, and that's the same 20 million. Where are we getting that from? Well, we're using our cash, so we need to decrease our cash account with a credit for that same 20 million. So over here on our balance sheet, our assets would decrease. Our liability is also decreasing, so we're still in balance in total. Paying off bank loans, also a financing activity on our statement of cash flows. So back to our original question, how many different accounts and what are those account names? Well, we've got 3 different accounts. Cash, which we've used twice, contributed capital or capital stock, and notes payable. So our answer here to 21 is this one right here. 3 accounts involved, contributed capital, cash, which we used twice, and then notes payable. And that's it.